Hello, everyone from Berlin today. As always, we will start the conference with the statements by Matthias Döpfner, our CEO, followed by Julian Deutz, our CFO, and we will then turn to the question and answer session. We've published the annual report this morning, and I hope you received our presentation. And with that, I would like to hand over to Matthias Döpfner.
Hello, everyone. 2018 has been another very successful year for Axel Springer. To be precise, the best year in its history with regards to its profits, its EBITDA, which is the highest ever, but also with regard to its margins, which are the highest ever, and with double-digit revenue growth for the digital businesses of the company. Let's take a look at the most relevant KPIs on chart 3 before Julian will give you more details on the financials. We have had revenues of 3.2 billion euros, which represents an increase of 4.1%. The organic increase stood at 3.8%, with the classifieds business again being the growth driver. Our adjusted EBITDA amounts to 738 million euros and is up 14.3% on a reported basis. This includes the effect from the implementation of IFRS 16. Growth on an organic basis reached 8.5%. The adjusted EBIT increased by 4.7% on a reported basis and was up 6.4% organically. Finally, the adjusted EPS stands at 2.73 euros, which corresponds to a reported increase of 5.1% and an organic increase of 8.3%. This all means that we have achieved our group guidance for revenues, adjusted EBITDA and adjusted EPS for the full year. Our guidance for the adjusted EBIT was outperformed on the reported basis. Regarding the dividend, and in line with prior years, we want to let our shareholders participate in the economic success of Axel Springer. We are therefore keeping the payout ratio high, which translates into an increase in the proposed dividend from 2 euros in the prior year to 2.10 euros for the 2018 business year. You all know that for many years we are predominantly a digital company. Chart 4 shows where we stand in that respect in 2018. 71% of revenues and 84% of adjusted EBITDA is from digital activities. A 71% digital share of revenues compares to 67% share in the full year 2017 if you adjust for the effect from IFRS 15. Digital revenues have grown by 9.6% on an organic basis. On chart 5, you find the objectives we have set for ourselves for 2018. First objective, further growth in classifieds. Our classifieds businesses have shown a reported revenue growth of 23% and an organic growth of 11.4%. We will discuss the classifieds business in more detail in some minutes, but these numbers already show that the operative performance has again been strong and that the kind of economic backbone of the company is generating robust double-digit top-line growth. Secondly, we have delivered on our midterm stable adjusted EBITDA guidance in news media. The adjusted EBITDA we have achieved in 2018 is within the range we communicated 2 years ago. Thirdly, we have seen a considerable improvement in EBITDA at Insider Inc. this year. As you probably know, Insider is the new name for the holding company of all the Insider brands. Amongst those, Business Insider is clearly the most well-known, the biggest business brand globally with regards to reach, and also one of the top 3 American digital news brands, bigger than the Washington Post, on the level of the New York Times, and still smaller than CNN. Our goal was to break even in 2018, and Insider Inc. has even slightly surpassed this goal by ending the year with a small EBITDA profit. And I think with that, it's proven that digital content can be and will be a very attractive business model with extremely interesting growth opportunities. Average top-line growth of Insider over the last 3 years is 8%. Finally, we have said that we want to explore and use further potential from technology and data. We have made good progress here. I think it is fair to say that we have achieved our goals. Chart 6 summarizes some of the highlights of the most important segment, the classifieds. I've already mentioned the strong organic growth the classified businesses have again achieved. Most of this has been driven by Stepstone, our jobs classified business. They have grown their revenues by 16.9%, which is almost exactly the same level they have achieved last year. With that, Stepstone Germany has even shown a 25% organic revenue growth, and Germany is by far the biggest market of Stepstone. Classifieds business continues to be the most important profit contributor of our group. 60.5% of our EBITDA comes from this segment. 1 year ago, this number was at 56.8%. In addition to the strong organic growth, we also had some additions to the portfolio. Firstly, the acquisition of Logic Immo by SeLoger was closed in the beginning of 2018, and the following integration process has already brought forward promising results. The most prominent example was the start of the first joint venture offer in second half of 2018, which will be followed by a more comprehensive joint offering this year. In the jobs classified space, Stepstone acquired a leading player in the employer branding business and provider of important data such as salary comparison. Stepstone made another step in this direction with the acquisition of StudyDrive in the beginning of this year. And of course, on the real estate side, we started to be active in the hybrid agent business with a minority investment in Purple Bricks. At the end of the year, together with Purple Bricks, we invested in Homeday, the most promising startup in this area in Germany. But many of you have followed the disappointing share price development of Purple Bricks, especially in the last weeks. However, looking at the underlying business model and the growth in the core market, UK, we are still convinced that this is a very promising model, and the development Purple Bricks is showing in the UK is supporting that view. On chart 7, you find developments and milestones in the content business. Firstly, as I already mentioned, the financial targets and most importantly, the adjusted EBITDA target have been met. Secondly, we are extremely happy about the good development at Insider Inc. They showed another year of strong revenue growth and became profitable. And also in terms of reach, Insider was very successful and became the second most read general news brand in the US. This means they had more uniques than well-known brands such as Fox News and others. But also our other younger digital businesses such as Update or Politico had a very good development. Both are aiming for profitability in 2019. All these developments show that contrary to many people's beliefs, it is possible to make money with digital content. Continue to convince those who might still be doubtful. Digital content is going to be a very important growth driver for Axel Springer going. To that end, it is also worthwhile to mention that our digital subscription of Bild and Welt crossed the 500,000 subscribers milestone last year and ended the year at 512,000 subs, which is an increase of 10.9% year on year. We are especially happy that more and more of this growth is driven by conversion from articles with very low or almost zero marketing investments. If we would invest more in marketing, these figures would look different and unlocked potential. Before Julian talks in more detail about 2018 and 2019, I would like to give an overview of what we want to achieve on chart 8. To a large extent, we want to continue with what we have done so far. We want to focus more and more on the classifieds and the content businesses. Those are the two main pillars of the company. Those are the two strategic goals to achieve on both levels, globally market-leading position. We want to further grow in that spirit the classified business organically and inorganically, and will continue to digitize the remaining small part of analog content business, less than 10%, and foster growth of the digital. We will also make even more use of the potential from technology and data than we have done so far. We have laid the groundwork in 2018 and are now in a position to start and scale these initiatives. In addition, and as we have already communicated in December at the Capital Markets Day, we will shift our focus more to top-line growth than before. We simply have a lot of businesses where it would be wrong not to invest in order to make use of the growth potential that is out there. In that sense, we want to make the Stepstone business even stronger and build on its already strong position in Germany, but also in other markets. In the real estate classified business, we are expanding the product range with a hybrid agent model and the seller lead product, and also with regard to the growth potential of the existing business models of real estate classified platforms. And of course, with regard to content at Insider Inc., we want to reinvest the profits we are now achieving into the business to grow revenues further, and we will do that also with other, at the moment, smaller businesses and models like Politico Europe, which is going to achieve profitability in 2019, and also with regard to Update, Europe's biggest news app that has shown very impressive growth last year and had a good start in 2019, many opportunities. One thing definitely stays unchanged. Our overarching goal is to create mid and long-term shareholder value. And in order to do that, we think that investment into the fast-growing businesses of this company is a top priority in the interest of. With that, let me hand over to Julian for the financials and the outlook in more detail.
Yes, good afternoon also from my side. Let's start with a look at the group financials on chart 10. Total group revenues have grown 4% on a reported basis and 3.8% organically. Adjusted EBITDA was up 14% on a reported basis, and roughly half of this effect is obviously, or half of this growth comes obviously from the IFRS 16 effect. So if you look at the organic development, which is the right way to look at it, both on the 18 and on the 19 numbers, we believe the increase was 8.5%. Consequently, we have achieved our group guidance for the full year, as Matthias has just mentioned. Q4 has seen an even better growth in adjusted EBITDA with organic growth of 13.7%. This was due to a great performance in our job classifieds business, as well as a strong year-on-year development in news media. Adjusted EBIT increased by 4.7% on a reported basis. Organic increase here was 6.4%. Let's turn to classifieds on chart 11. You see the overview for our classified segment, which continues to be the driver of revenue and EBITDA development for the group. Revenue were up by 20% on a reported basis and by 11.4% organically. Organic growth in Q4 stood at 13.3%. So with regard to organic growth, the strongest quarter of 2018. Like many years before, we closed also 2018 again with a low double-digit growth, organic growth in our classifieds business. Adjusted EBITDA grew by 17.9% and was up organically by 11.4%. As you know, we've been investing in 2018 in order to further increase our revenue and profit potential in our various businesses, and correspondingly margin declined by 0.8 percentage points. In part, this was also due to the inclusion of lower margin businesses such as Logic Immo in France and Universum. Due to the fact that the phasing of the investments was more geared towards the first half of 2018, we saw again a margin improvement in Q4 2018, as has already been the case in Q3, so margin in Q4 was higher than in Q4 of 2017. Let's move to the jobs vertical on slide 12. We've seen another year of very strong performance in line with our expectations in this segment. Stepstone, so the jobs vertical, remains a growth engine within classifieds and for the whole group. Stepstone grew its revenues by 21.5% on a reported basis, including the consolidation effects from Universum. Organic revenue growth was also again strong at 16.9% for the full year, so on the same level than the 17% we've seen in 2017. Continental Europe obviously continues to be the growth driver with organic growth of 22.3%, with Stepstone Germany having grown at even 25%. Adjusted EBITDA in jobs grew by 20.9% and by 14% organically. As expected, the increase was again stronger in Q4, with 40% reported and 33% organic EBITDA growth following the stronger marketing spend in the first half. Consequently, we've seen a significantly better margin in Q4 with a plus of 5 percentage points as guided to before. We had a guidance for EBITDA margin that assumed a margin slightly below the prior year and with a decline of only 0.2 percentage points a year, and it's there a bit better than expected. Moving to slide 13 for the real estate classifieds, revenues here grew on a reported basis by 29.4%, mainly driven by the acquisition of Logic Immo. Organic growth was at 6.1% for the full year. Adjusted EBITDA also increased strongly by 18% for the full year. The organic increase of 11.7%, mainly due to Immowelt, was further supported obviously by the IFRS 16 effect and the consolidation of Logic Immo, and slightly burdened by the negative at equity consolidation effect from our stake in Purplebricks. Looking at the segment margin, let me remind you that the decline of 4 percentage points or 4.4 percentage points is due to the lower margin of Logic Immo, so the intake in the portfolio and the negative contribution of Purplebricks. Without these effects and excluding IFRS 16, so the real organic margin development would be an increase of 2.7 percentage points. And I think this gives you an idea how strong these businesses are. Finally, in classified, slide 14 gives more details on the general and other subsegment. Reported revenues here grew by 5.8 and by 5.9% organically. We continue to see a good development at La Centrale in terms of revenue growth. Revenue growth at leisure has shown a strong finish to the year with low double-digit organic revenue growth in Q4, driven by a good winter season and holiday rentals and strong business with some of the big partners. Furthermore, organic growth at leisure picked up due to the sale of the aggregator Casamundo as of October. This strong development is the main reason for the higher organic growth within general other in Q4 of close to 11%. Looking at the full year development, Yacht 2 in Israel continues to be impacted by regulatory changes in the real estate market and showed only slight organic growth and a decline of reported revenues due to negative FX effects. Adjusted EBITDA for general other was up 10.5% to 80 million euros. On an organic basis, the increase was 5.2%. Margin was up compared to the prior year and stood at 34.1%, slightly up for the full year and showing a stronger increase in Q4 due to the better operative development of the assets and again for the deconsolidation or due to the deconsolidation of Casamundo. Let's move on to news media on chart 15. What I think is remarkable here that within this segment, which has now close to 40% digital share of revenues, but still 60% print revenues, we kept revenues for the full year almost stable. I think in particular compared to some of our peers, this is a really good development. The revenue development obviously reflects the different degrees of digitization in the national and international business. So 28% of revenues in Germany are digital, and the international news media business is there further advanced with already 65% of revenues coming from digital. And as a consequence, while digital revenues are setting off the decline in print revenues for the whole segment, in national revenues are down by 3.5% reported and 4% organically due to the declining trends in the print business in both circulation and advertising. In international, with a strong part of digital revenues have grown by 6.3%, organically even by 11%. We had a deconsolidation effect from the sale of our printing activities in Slovakia, and obviously had a very strong growth effect, organic growth effect at Insider. As Matthias already said, the adjusted EBITDA was achieved in line with the midterm range we have communicated 2 years ago as a target for the segment. Looking at the year-on-year development, adjusted EBITDA was up 4.3%, mainly driven by effects from IFRS 16. Adjusted for those effects as well as consolidation and FX effects, adjusted EBITDA was down 3.5%. Positive effects came from the international business with significant improvements at Update, Insider, and Politico. Short comment on the stronger organic decline of the adjusted EBIT, which was down 12.5% compared to only minus 3.5% for the adjusted EBITDA. To a large extent, this is due to higher depreciation following the sale and leaseback of the headquarter buildings in Berlin. Let's turn to marketing on chart 16. Revenue and adjusted EBITDA development in the marketing media segment was in line and partially slightly above the guidance that we adjusted downwards with the publication of the Q3 results in November. As you know, the development has been impacted by the sale of Au Féminin, with reported revenues down 12%, excluding consolidation and FX effects, revenues were up 2%. The organic revenue development within reach-based marketing was impacted by the US exit of Bonial, which we don't count as a consolidation effect because technically it simply an operational effect at the end of 2017 and was on the prior year level. Performance marketing showed an organic increase of 5%. Adjusted EBITDA was down 6% with a stronger decline in Q4 due to higher integration and restructuring cost for the merger of Awin and Affiliate and a strong prior year quarter at Finanzenet. You might remember that in the end of 2007, we had some very nice effects driven by the hype of Bitcoin. On chart 17, looking at the bottom line, adjusted EPS was up 5% and stood at €2.73. On an organic basis, adjusted EPS increased by 8.3%. Also, everything there in line with the guidance. Depreciation and amortization increased from €142 million to €210 million. This was due to the first-time adoption of IFRS 16. EBIT was up 4.7% to €527.9 million. The financial result was at minus €21 million after minus €18 million in the prior year. Tax rate on the adjusted results stood at 33.7% for the full year. Q4 taxes increased from €36.8 million in the year before to €54.7 million in 2018 due to tax expenses for prior years. The negative reported net income in Q4 18 was of course driven by the impairment of our stake in Purple Bricks that Matthias has already mentioned. Let's take a look at our net financial debt and free cash flow on chart 18. Net debt at the end of 18 stood at €1.25 billion, which corresponded to a leverage of 1.7 times EBITDA. Net debt, as you know, has been impacted by the effects from IFRS 16 quite heavily, much more than the adjusted EBITDA. It includes leasing liabilities of roughly €380 million, thereof €150 million attributable to the lease of the Axel Springer Passage here in Berlin and our high-rise. The effects from IFRS 16 and from the lease of these two buildings that I just mentioned have increased our leverage by around 0.4 multiple points. So, if you will, in the old world, the leverage would have been 1.3 times. As you know, our free cash flow is impacted by the effects from our headquarter real estate transactions that are, by the way, all going exactly to budget and to time plan. So we're happy with that. Looking at the free cash flow numbers without these effects, and we believe that's the right way to look at it, the strong increase in 2018 for free cash flow, you see that here the red columns, was significantly above our expectations. To set expectations right now for 2019, it's important to note that the 18 cash flow has been positively affected by phasing and one-off effects in the magnitude of roughly 50 million euros. So most of the positive surprise happened in December, and obviously most of this will reverse in 2019 and has already reversed in the first weeks of the new year. And if you remember, the guidance we gave there for free cash flow for 18 was on prior year level or slightly above. So this is now significantly above, and again, roughly 50 million is money that we had expected only in 18. So let's take a look at the 2019 outlook, which is probably for you and for us the most important part of this presentation. We expect a low single-digit percentage increase in revenues on a reported basis. Adjusted for consolidation and FX effects, we expect an increase in the low to mid-single-digit percentage area. We expect the adjusted EBITDA on prior year level with an organic increase in the low to mid-single-digit percentage area. So here, I'm happy to talk about in Q&A a little bit more about that. Please keep in mind that we have significant consolidation effects. So we sold profitable business in 18, and we invested in still loss-making, high-growth businesses in 18. So this is causes the difference between the organic and reported guidance in adjusted EBITDA. It's important to mention that we expect a quite back-end loaded phasing for the EBITDA. Some of the reasons for this are the final deconsolidation effects from the Au Féminin sale, strong H1 comps for the news media business, in particular in Germany, thanks to a good start in 18, and again, some front-loaded marketing costs at Stepstone. We also had quite high restructuring expenses in the final quarter of 2018. Depreciation is going to increase again this year. We should therefore see the adjusted EBIT decline in the low single-digit percentage area on a reported basis. Organically, we expect a low single-digit percentage increase. Regarding adjusted EPS, we expect a stable development to a low single-digit percentage decline on a reported basis, adjusted for consolidation and FX. Expect a single-digit percentage increase. On chart 21, you find our detailed outlook for the segments, both reported and organic. I'm not going to talk you through all the details, but just want to mention two important aspects in the classifieds field. In classifieds, we are expecting to see a continuation of strong organic growth. We expect a high single-digit to low double-digit percentage organic revenue growth for 2019. I'd like to flag that we expect some phasings also here in the job segment. Due to this, the start into the year should be slower than the following quarters, both for Stepstone, so for jobs, but for the whole subsegment. For the full year, we continue to anticipate strong organic growth at Stepstone, although after 2 years with spectacular 17% growth and even 25% in the German core market, we should probably see an organic growth a bit or slightly below prior year levels. For the adjusted EBITDA, we have communicated at our Capital Markets Day in December that we are planning additional investments in 2019, especially in the real estate subsegment. As a result, we expect an increase in the adjusted EBITDA in the low to mid-single-digit percentage area. The organic increase should be in the mid-single-digit percentage area. The adjusted EBIT should be on prior year level with an organic increase low to mid-single-digit percentage area. Also, let me remind you that the services holding adjusted EBITDA was positively impacted in 18 by lower expenses, stock option programs, lower project costs, and lower restructuring. We therefore expect a return to a higher level of losses. So this was it from Matthias and my side, and we are now looking forward to your questions.
Ladies and gentlemen, at this time we will begin the question and answer session. Anyone who wishes to ask a question may press star followed by 1 on their touch-tone telephone. If you wish to remove yourself from the question queue, you may press star followed by 2. If you are using speaker equipment today, please lift the handset before making your selection. Anyone who has a question may press star followed by 1 at this time. And 1 moment for the first question, please. First question comes from the line of Chris Jordan with HSBC. Please go ahead.
Yes, thanks for taking the questions, guys. So first one, running through your investments once more, please. I mean, I kind of understand that you're saying we have a lot of businesses where we'd be wrong not to invest, but arguably 0% EBITDA and EPS growth isn't great either. So I'm kind of trying to think how you're thinking about short-term profitability versus long-term investment in general. Because I mean, what if next year is just another year where you have a lot of businesses where it again would make sense to invest. Could we see this repeat? So maybe some bigger picture view on short-term profitability versus long-term investments would be interesting. That's my first question. Thank you.
So, Chris, thank you. First of all, the 0% EBITDA growth that you quoted are obviously the reported figure and not the organic figure for the reasons you pointed out. We believe here it is fair to include obviously the disposal or the effect from the disposals of non-strategic assets or less strategic assets like Au Féminin, for example, or the print business even in Slovakia. So this is why we believe that the organic growth rate is a better view on that. We discuss in each and every budget process, obviously very carefully, the balance between investments on the one hand side and short-term profitability. If you see the last 2 years, we I think showed very good earnings and bottom line growth development for 2019, and I think we flagged that relatively clearly or as clearly as possible at that point in time at the Capital Markets Day. We believe it makes sense to invest in classifieds and Business Insider. The effects, if we would not invest now, we wouldn't see any harm probably for the next 12 to 18 months in classifieds. So classifieds would continue to grow very nicely. However, we believe it would simply be in the midterm the wrong decision. So we believe that in particular in real estate, we see not only at Axel Springer but also at other assets that obviously growth rates that were low double digits there are coming down step by step, and in the case of Axel Springer, as you know, are more now in a range of 6 or 7%. So we believe it makes sense to invest there now in seller leads. We believe it is right now to invest in new and obviously a little bit unproven or less proven business models like the hybrid agents, even if obviously the timing of our Purple Bricks investment was not perfect, no doubt about that. So we take this decision, this balance very serious. But for 2019, we went for investments, and we believe this is the right thing to do. If you look on a longer-term horizon, and Matthias mentioned that mid and long-term shareholder value is a very, very high objective, if not the central objective of management, we see obviously classifieds as the main top line and bottom line driver of Axel Springer. So this view has not changed. I hope this answers your question a little bit.
Yeah, maybe we could
just to clarify your point that you made, that this is going to repeat now for the next 5 or 10 years, or that we are moving to a kind of flattish or negative EBITDA path. That is not the case. I mean, we have the short-term effects, and by the way, I think in a still very reasonable and conservative dimension, because if we're saying EBITDA is on a kind of organic basis growing, if you take out the kind of acquisitions and sales and non-organic effects, despite this double-digit investment. But this is something that we do now, and we will see in the midterm the effects and the very positive effects both on the top line growth level and also on EBITDA level, which will benefit from that in the mid and long term.
Yeah, maybe follow up on that. Maybe it will make sense to go through some of the scope changes, because on my figure, what you consolidated in 2018 for Au Féminin is some 4 to 5 million of EBITDA, so it's not that much. So I think most of the stuff is coming indeed from Purple Bricks and Homeday, and those sort of losses, while calculated outside the organic figure this year, will probably still be there to quite a significant extent next year. So maybe you mentioned the Slovakian sale. Maybe it would just make sense to put the scope changes 19 versus 2018 into perspective a little bit to get maybe I'm having the wrong idea here about the losses post 2019.
Chris, it's Julian here. Very happy to do that. So overall, the difference in EBITDA for 2019 between the organic and the reported view, if you compare to 18, is in the ballpark between 20 and 25 million. And as you say, it's roughly 5 million. So the biggest single items there are, on the one hand side, roughly 5 million effect from Ophimin sales, so EBITDA, which was there in 18, which won't be there in 19, and then very roughly around 15 million in classifieds, most of that coming from Homeday and Purple Bricks, also a little bit coming from the new acquisitions of Stepstone. So this is why this is quite a gap. I mean, it's roughly 20 to 25 million here. Obviously, we are not in a position to give detailed guidance now for these hybrid agent models for 2020 or 2021. However, if you look, for example, at Purple Bricks, we see a situation where the UK business continues to grow and continues to be obviously profitable and to increase profitability. And the question is there, how is a company continuing with their big and obviously loss-making initiatives in Australia and in the US? But overall, we would definitely not believe that the kind of hit in EBITDA that we take from that should be higher in 20 than in 19. And then obviously we have Homeday, which is a kind of startup business where also 19 is a year of relatively large investment for our group's standards. And obviously there will also be some investments in 2020, but for Purple Bricks it should be lower definitely.
Okay, and then one last question on Stepstone. I mean, can we talk a little bit more on what type of investments we should expect in 19? Because I think big part of the question is, with traffic acquisition costs going up and you being back on TV with advertising, and the competitive situation with Indeed not having changed. I mean, how much of it is due to those sort of general cost items where you have to sort of fight back, and how much is, the greenfield launch in Poland, the other investments you're making greenfield, just to get an idea of how much of it is, I guess, out of a position of strength or out of a position of weakness is, I guess, where I'm getting at.
Yeah. The investments in the kind of new territories or countries like Poland or France, that's a single-digit million euro amount. Overall, what you could say, if you look at Stepstone, you could say very roughly, if you say a kind of going constant scenario is a constant margin at Stepstone, we see additional investments in terms of OPEX, and there the number I just mentioned or I just guided to is already included, is roughly 20 million kind of additional impact. And that is due to investments in mainly two areas. It's investment in online marketing and in brand building, and this should secure superior candidate delivery in a job market, which in Germany is flat in terms of candidates on the supply side and is confronted with a lot of talent shortage on the demand side. And we will also further strengthen or increase our sales capacities and secure growth in revenue and market share. And there the bottleneck is not really money or budget. There's a bottleneck is availability of the right talent on the market. And I think due to the nature of these investments, it is simply impossible, and I know exactly where you're getting at, but it's simply impossible to really say what is growth investment or what is investment in grabbing more market share and what is investment in keeping competition small, like we succeeded to do that over the last couple of years, as you know. I think this all goes in the right direction, and these are the investments we make. And we believe with these investments, we will have another very successful year with double-digit growth rates, even if from our point of view today, not as high as the 17% from last year at Stepstone. And if we look at the things we did in 18, and we know that we got criticized exactly a year ago on that very call in 18 for the announcement of making additional investments in the first half year at Stepstone. We secured with that, again, 17% growth. And this is why we believe, even if we sacrificed 3 or 4 percentage points in margin in the first half of the year, and obviously recuperated most of that, not all of that, but most of that in H2, with that growth and with this market share growth in a market which is still obviously growing and still has a lot of print to digital shift in front of us, we believe that's the right thing to do.
Okay, thanks, guys.
Next question comes from line of Nick Dempsey with Barclays. Please go ahead.
Good morning, guys. I have 2 questions. So first of all, you're suggesting that Stepstone is going to start the year more slowly in terms of organic revenue growth and should do better later in the year. Can you just explain why that shape is going to unfold? And is that related to the sort of timing of these investments that you were just mentioning in the previous question? Second question, in your news media organic growth guidance of low single-digit decline, are you expecting a better or worse year in 2019 for the German newspapers than 18?
So, Nick, thanks. Starting maybe with the second question, we do not expect a better year in terms of, and I think you go at print advertising mostly in the German newspaper market in 19 than in 18. And you know that in 17 and 18 we had some months and some quarters even with surprisingly good and stable advertising, and our plan doesn't foresee that this will happen again, but also, quite frankly, signals that we get from the market side don't really give indications that this would happen again. So in a way, there is no optimism built in our budget at that at News Media. First question, I think the other question was the timing of the phasing of Stepstone's revenue development. First of all, what might be interesting here, if we look at the order entry at Stepstone for the last 8 or 10 weeks, then in Germany we are above 20%. We always have some gap between order entry and revenues because there are always some cancellations, but it shows you that it's really strong demand. Consumption is currently a little bit weaker, so consumption of these listings or usage, however you want to call it, a little bit slower than it was a year ago. So for phasing, first of all, we have the introduction of the partnership model in UK, which will lead to higher growth starting in Q2. And we had more longer-term contracts in Q4 of 2018 that phase longer into the year instead of short-term contracts. So the mix has slightly changed, and this is why we expect Q1 probably to be the, in terms of organic revenue at Stepstone, the quarter with the lowest growth and then increasing growth rates. And I think if you see our guidance also on a quarterly level last year, we have at Stepstone, I think, quite a good view and reasonably good projectability for these kind of developments.
Thank you.
Next question comes from line of Catherine Tate with Goldman Sachs. Please go ahead.
Morning, Good afternoon, everybody. Just following up again on Stepstone. Thanks for detailing or outlining the details of the investments. Can you, I suppose, help us understand, going from here, how we should expect that ARPU versus sort of volume or order entry trajectory to run, both within Stepstone and then also curious to sort of understand, how you're thinking about those two dynamics within the real estate business as well. And then perhaps my second question, just on marketing models, can you give us an update on how you're thinking about their position within the broader group? Thank you.
Yeah, perhaps I take the marketing question. I think we have said already in the past that this is not an essential element of our strategy. We have made a big sale at very fortunate multiples between 15 and 16 times EBITDA multiple for basically non-growing business. That was a big step. The next thing that we have announced is an IPO or sale of Awin, and the remaining assets. There is on the one hand FinanceNet, that is a very nicely growing and super profitable digital content asset that has already established a successful joint venture with Business Insider called Markets Insider in the United States. Its core business in Germany, Swiss and Austria is doing extremely well. So this is just in a way in the wrong segment and is already a kind of essential part of our business information cluster and is going to remain in the content segment. And then there remains only Idealo and Ladenseiler and Bonial. And for Ladenseiler and Idealo, we have already decided that we will and are already very aggressively cooperating with the digital content brands and take advantage of their reach and enrich the service level of the content offerings by the possibility to directly with one link compare prices of products and services. This has been reflected already in the very recent past in a very positive development of Idealo that had a particularly good start into this year. And so that will remain in the content segment. Then there's only Bonial left, and we will find a solution for that. So in the mid-term, in the very foreseeable future, this company will be entirely based on digital content and digital classifieds, also in order to simply simplify the structure of this company and focus on the things that we do best and most successful.
Catherine, to your first question, so the main difference from our point of view between real estate and jobs classifieds here is that in real estate, most of the growth is really coming from price, so basically coming from APA growth. We've even seen in Germany in 2018 the development that APA growth has been slightly higher than overall growth, meaning that the number of agents went down slightly. In jobs, it's really a different ball game. There we see that simply with existing customers, with large existing customers, have kind of inherent growth because they simply, without any new customer acquisition, they put more and more job advertising on the most efficient platform, and that is simply Stepstone in Germany. So there's growth is coming roughly 50-50 from volume and from price.
Next question comes from line of Sarah Simon with Berenberg. Please go ahead.
Yes, hi. I've got three, please. First one was just a numbers one. On IFRS 16, can you just, I don't think you gave us the final impact in terms of what it did from an EBITDA perspective, and if you could split it between the business units, that would be really helpful. Second one was depreciation. You highlighted that it went up, but there's still quite a big gap with CapEx. Over what kind of period of time do you think that gap's going to close? And then the third one was on Insider. At the Capital Markets Day, I think you said, look, it's kind of broadly broken even now, but we're going to keep investing in terms of new additions to drive the top line, and that we should think about Business Insider contribution as being kind of broadly break even for the, let's say, for the medium term. Is that still the case when we think about kind of 2019, 2020? Thanks.
Hi, Sarah. Let me do the first two questions, and then Matthias is taking the question on Insider. So the first question, and you find it somewhere also in our annual report, the split by segment from the IFRS 16 effect out of the 45 million euros, it's 44% from news media, 38% from classifieds, and 18% is marketing media. And the question when the kind of gap closes between CapEx and depreciation, on what time horizon, it is probably either 20 or 21. So either 2020 or 2021.
Okay, thanks.
Okay, and on Insider, I mean, it generated its first profits last year despite double-digit investments, and it would be very easy for this year and for the years to come to increase the margin every year and to very fast get to a 20-30% margin of the existing Business Insider business, which is at the moment roughly 100 million euro top line business. I strongly doubt that this would be a reasonable way to develop that brand, and that would be in the interest of Axel Springer's shareholders, because Business Insider has the potential to now go from 100 to a billion, and then to take it from there. The growth is fast, on average 38% over the last 3 years. The reach with short-form video, 10 billion. Is the last figure. The reach with 170 million uniques. The market leadership in business and finance information, the second biggest news platform. I mean, we really think that we should invest in Insider and at least reinvest the biggest amount of profits that they're doing. It should remain on a kind of low single-digit million profit level over the next years, in order to just show that it is structurally a profitable business. But to maximize margin and absolute profits here would just be the wrong priority, because we think that business is a global digital media brand, a global digital media company with the potential to build additional verticals from Car Insider, Travel Insider, Pet Insider, People Insider, Sport Insider, you name it. It really has almost unlimited potential. It's in 19 countries. It could be in 100 countries or more already today. More than half of its readership is out of the US, is global. We are investing at the moment in Business Insider Germany under a new leadership, and we think we have to keep the balance here, but our focus is not maximize profits short term.
Okay, thanks.
Next question comes from the line of Nizla Naizer with Deutsche Bank. Please go ahead.
Great, thank you. I have 3 more questions from my end, please. The first one is on Stepstone. We've heard from one of your competitors, or smaller peers, that Google for Jobs may be entering the German market. Just wanted to get your idea on what the strategy is in case they do, and what, if any, impact would that be on Stepstone? And you also mentioned that one of the investments going into 2019 is on the sales force. Could you remind us how large is the Stepstone sales force at the moment, and how many incremental salespeople do you intend to add as a part of that investment drive? My second question is on the portfolio streamlining. You mentioned that you sold Casamundo within the travel group. What's the impact on financials of that sale, and do you think there's there's any more portfolio streamlining that you would like to do within the classifieds group. You mentioned marketing media not being core, but just to understand if there's anything else within the portfolio that you'd like to streamline. My last question is on news media. The EBITDA guidance is for EBITDA to be at the prior levels. Just wanted to understand if some of the smaller digital assets are also breaking even and becoming profitable. What would it take for that EBITDA to expand, or are you happy with keeping it at these levels? Just get some clarity on that. Thank you.
Yeah. So if it is about StepStone and Google for Jobs, I mean, in a way, since our acquisition of StepStone for 130 million in 2011, which was then considered to be much too high and totally overpaid, and share price went down, and we were criticized. Today, the profits of StepStone and the growth of StepStone and the value of StepStone to a certain degree. We are used to the fact that with Facebook, LinkedIn, Xing, and other players are considered to destroy StepStone and its business model. So far, exactly the opposite happened. StepStone is growing every year, absolute figures, the dimension of about 2/3 of Xing's total revenues. StepStone has taken more share from Monster in Europe than LinkedIn did from Monster in the US, which seems to show that it is a internal structural Monster issue and not a kind of strategic LinkedIn job board issue. And the same is true for the role of Google. Google has been active many years ago in the classified business in real estate in England and in Austria, didn't succeed, stopped the activities. Now we have Google for Jobs. And it really depends on the strategic reaction of the big players, how sustainable that will be. We have decided to test in the UK to allow Google for Jobs to use our inventory and to see what our benefits on the reach and revenue side will be. In markets where we are stronger, like in South Africa, we have not allowed Google for Jobs to use our content, and we saw that Google for Jobs was not growing appropriately and sufficiently, and for that reason we have also decided not to allow Google for Jobs to use our content in our biggest market, Germany. So we do not see so far any negative impact from Google for Jobs, and we think that the likelihood in the long run that this is going to create a negative effect on StepStone is very small. But as always, we take any competition very seriously, and it's always better to overrate activities than to underestimate them. And it is also, of course, on top of that, a regulatory question whether it is whether it's appropriate from a concentration point of view and point of view market power. But that's a different discussion. We focus more on the business issue.
Okay. And Nizla, you asked for Casamundo, I think, for the kind of deconsolidation effect. So it's a business with a little less than 15.5 million revenues and almost no EBITDA, which, by the way, was one of the reasons. Sell it. And I think the last question was on the new media development. Yes, it's completely right that we see positive development in the younger digital pure plays like Upday and Politico. However, we don't see any relief on the print advertising side, so the effects of these small businesses change our overall view.
With regard to the sales force of Stepstone, we don't have a precise figure here. Stepstone is hiring in 2019 in Germany only 300 new employees, out of which a significant percentage is in sales. So the focus on the new hirings is in sales to increase the sales power.
The next question comes from the line of Patricia Pear with UBS. Please go ahead.
Yes, hi. I've got 3 questions, please. The first one is on the investments in all these new products and services for the classifieds business. So I'm thinking about data in jobs and the products for agents at Celoge. When are you expecting to see a return on those investments, or when do you expect those products to contribute materially to revenue? The second question is on real estate. If you can talk about the trends for Immowelt and Immoweb in Q4 18, where revenue growth decelerated, and particularly for Immowelt, whether you can talk about the Asian losses, where are those coming from, whether it's market or competition issue. And then my last question is really on how to generate more value. So I know at the Capital Markets Day you talked, or you mentioned that you were not considering a spin-off of the classifieds business or reevaluation of the structure at that point because you didn't see the benefits to shareholders at that time. I'm just wondering what would make you reconsider that. Thank you.
Yeah, thank you, Patricia. You're right. We said on the Capital Markets Day in December that thinking about the right structure for the group is something that we believe is an important task of top management, and there's really nothing to add to that. The question, when do we expect a return on investments in new products? There you have to differentiate, I think, between some of the investments in jobs. In the jobs field, if it's obviously things like additional traffic acquisition, that's something where we see a return within the same business year, like you saw, for example, in 18 at Stepstone. If we talk about things like seller leads, it's more difficult to say. It's probably the kind of normal digital time frame of 2 to 3 years, and this will depend from market to market and from product to product. And your third question, the deceleration in real estate in Q4 in Immowelt and Immonet. It's a question often of the kind of phasing out from the initial round of new price increases, and we had that obviously post the introduction of the duo offer in Germany at Immowelt, and that has now been phased out, and there you see this effect. So we focus currently, in addition to that, I think you also asked for why the number of customers, and I had mentioned that before, is going down a little bit. We try to focus more on higher volume customers because there's simply better economics with these customers, and therefore are losing some of the small ones. This is why indeed ARPA is increasing stronger than revenue at Immowelt, both in Q4 and for the full year of 2018.
Just a quick follow-up on price increases. Do you plan to do like once every year, or what's your policy there?
Patricia, we have a policy of kind of regular price increases. We never want to announce that before, as we would signal that to our competitors. but we have a policy in all our real estate classifieds businesses of regular price increases, and part is done by an increase in price list, and the second part is coming from kind of continuous reduction of discounts.
Okay, and with that, we would like to close the call, and we thank you very much for taking the time and dialing in today. And as always, Daniel and I will be available on the phone and by email for further questions. Have a nice day. Bye.